All right, class, let's take a look at exercise 10.6 dealing with the investment center responsibility report. So the investment center of a company has the following relevant actual operating results and variances for operations during the fiscal year 2018. So actual sales were 30 million, and this led to a $2 million unfavorable variance. Variable cost of goods sold were 17,500,000, which led to a $550,000 favorable variance. Controllable fixed cost of goods sold were 2.5 million with no variance. Variable selling and admin expenses were 3.25 million, and that led to a $275,000 unfavorable variance. Controllable fixed selling and admin expenses were 1.5 million with no variance. Average operating assets for the fiscal period were 13.5 million. So based off of all of this, we're going to prepare a responsibility report. We're going to calculate ROI, and then we're going to talk about how we can actually improve ROI for the following year. So the first thing we need to do is prepare the responsibility report, and notice the format. The format follows a gross profit income statement, breaking out cost of goods sold and selling and admin to its variable and fixed components. So we get a little bit more detail, so we can get more insight into how this investment center actually operated. So they told us sales, the actual results for sales were 30 million. So that's how much they actually incurred. And there was a $2 million unfavorable variance. Remember, with sales, with revenue, for an unfavorable variance to occur, actual has to be less than budgeted. So that means to get our budgeted amount, we're going to add that variance to the actual number. That means we must have budgeted 32 million for sales if there's a $2 million unfavorable variance to arrive at our actual of 30 million. For variable cost of goods sold, actual results were 17,500,000. They said there was a $550,000 favorable variance. So that means we must have come in under budget. So remember, with expenses, for there to be a favorable variance, the actual amount is less than the budgeted amount. So we must have budgeted 18,050,000 for variable cost of goods sold, our actual plus that variance. That's how I came up with the 18,050,000. Fixed cost of goods sold, they said, was 2.5 million, and there was no variance, so we must have budgeted for 2.5 million, hence there's no budget, or no variance, I should say. Gross profit, how we calculate it, gross profit is simply sales minus cost of goods sold, so both the variable and the fixed component. So our actual gross profit was 10 million. Based off of our estimates, we would have expected to incur gross profit of a little bit more, 11,450,000. So the difference between those two, remember, profit is similar to revenue. If actual is less than budgeted, that variance of 1.45 million, we're going to label that as an unfavorable variance because we came in under budget in this case, which is a negative. Now looking at our selling and administrative expenses, we actually incurred 3.25 million in variable selling and admin. There was a $275,000 unfavorable variance associated with that. So when we're dealing with expenses and we have an unfavorable variance, that means the actual amount incurred must be greater than the budgeted. Hence, the budgeted is the difference between the actual variable selling and admin and the variance amount. So we must have budgeted for 2,975,000 in variable selling and administrative expenses. The controllable fixed selling and admin, there was no variance. They actually incurred 1.5 million, so that must be also the budgeted amount as well. Our operating income is our gross profit less our variable selling and admin less our fixed selling and admin. So our actual gross profit for the period, for the reporting period, was 5,250,000. Based off of our budgeted results, though, we were expecting an operating income of 6,975,000. So we have a $1,725,000 variance, and that we're going to label as unfavorable because, again, operating income is like revenue. If actual is less than budgeted, that variance is going to be unfavorable. Part 2 asks us to calculate ROI for the period. And remember, we can go about it in a few different ways. First, the items that we need to have at our disposal here, we have operating income of 6,975,000. So to calculate ROI, the variables that we need to have, and these are the actual amounts, we need operating income. So our actual operating income was 5,250,000. Actual sales were 30 million. And then average operating assets that was given as well was 13,500,000. Remember, there's two components to ROI. It's profit margin multiplied by asset turnover. Profit margin is operating income divided by sales. Asset turnover is sales divided by average operating assets. So we can calculate each individually, just so again, when we calculate ROI, we can see the components to it and we can dig a little deeper to see what affected our ROI. Our profit margin is simply our operating income of 5,250,000 divided by sales of 30 million. We get a profit margin of 17.5%. Remember, what does that number represent? What does 17.5% mean? It means that for every dollar of sales that we make, 17.5 cents is left over as income for this investment center. Now, asset turnover is a measure of how effectively we're utilizing our assets in order to generate sales. Because remember, the whole point of investing in assets for a company is to generate a benefit that ultimately turns into revenue for the business, in this case, sales for the business. We take our sales of 30 million, we divide it by our average operating assets. We had an asset turnover of 2.22. That means for every dollar of operating assets we invested in, it generated about $2.22 in sales. Now, ROI, our return on investment, is simply multiplying profit margin by asset turnover. So if we do that, we take our profit margin of 17.5%, multiply it by our asset turnover of 2.2%. That means we had a return on investment, in this case, a return on our average operating assets of about 38.9%. Now, remember, just looking at these numbers individually, even collectively, doesn't really give you information. Ideally, what you would do in real world and utilizing budgeted versus actual results, you would do a trend analysis and you would see year over year, how is our profit margin trending? How is our asset turnover trending? How is ROI trending? If it's trending upwards, obviously we're doing something right. If it's not, then we need to investigate why it's deteriorating year over year. Part 3 asks us, how can we improve ROI? And the reason I like going through this longer approach to ROI, you can see the components, you can see profit margin, you can see asset turnover. Those are the keys to improving ROI and changing it. Basically, we can improve ROI by improving profit margin. Well, how do we improve profit margin? Remember, profit margin, how we calculate it, it's operating income divided by sales. If you look at how do we get to operating income, it's everything above it on that income statement, on that responsibility report. So the way we can improve operating income are we can increase sales, which is obviously very difficult because the external consumer really controls that. We can do everything in our power, but if no one's buying, we can't really improve sales. The thing we have more control over are the costs because we decide when we incur the costs. So if we can improve costs, thereby increasing operating income, that's one way to improve ROI. And of the costs that we have here, variable and fixed cost of goods sold, variable and controllable fixed selling and admin, just by the very cost behavior nature, we have more control over the variable costs. So that would be the first thing I would investigate and focus on if I'm trying to improve my operating income. I would look into how can we lower this variable cost of goods sold amount? How can we lower our variable selling and admin? If we do that, everything else stays static. Sales remain the same. Operating income is going to go up. Therefore, profit margin is going to go up. And therefore, ROI is going to go up. Another way to improve ROI is maybe to invest in newer assets. Maybe these 13.5 million average assets, Maybe they're not operating as efficiently as they can. Maybe they're older, there's more breakdown, there's more stoppage, there's more rework, more waste, whatever the case is. If we're seeing that, then it might be an indication that we need to invest in newer assets. And where would I see that? I would see it with this asset turnover number. If I was to look to a trend analysis for asset turnover and I see that that number is decreasing year over year, that tells me that the assets that I have are not generating the same benefit year over year. And then that should make me start to investigate whether is it the assets' fault? Are they not as efficient as they should be? Or is it something else? And if I see that it is because the assets are not as efficient as they are, then I should start to investigate whether we need to replace them and make more capital investments in the business.